Welcome back to our comprehensive course on setting up and managing LLCs specifically for real estate investing. Building on Module 9, where we explored the nuances of business bank accounts for real estate LLCs from the exhaustive checklists of required documents like stamped articles of organization and EIN confirmation letters to comply with 2026's enhanced Know Your Customer protocols, to comparative analyses of banks like Chase and Bluevine with their REI-tailored features, such as subaccounts for per-property tracking and high APYs up to 4.25% on reserves, along with strategies for avoiding commingling through legal precedents like the landmark 2018 Delaware case emphasizing separate transactions to prevent veil piercing, and detailed insights into how banks evaluate LLCs via metrics like DMB scores and cash flow projections. Module 10. Accounting and Record-Keeping Foundations. This module is the backbone of your LLC's financial integrity, where meticulous practices not only ensure compliance with IRS rules amid 2026's heightened audit environment, but also optimize tax deductions for real estate-specific items like depreciation specifically up to $1.16 million under expanded Section 179 limits and passive activity losses, while safeguarding against disputes in partnerships or lender scrutiny during refinances. Poor record-keeping can lead to disallowed deductions averaging $10,000 to $50,000 per audit for REI entities, according to a 2010-25 Taxpayer Advocate Service analysis, or even veil piercing in litigation, where courts cite inadequate separation as evidence of alter ego status. We'll delve profoundly here, unpacking each subtopic with factual insights from IRS publications, GAAP standards adapted for small businesses, pros and cons, real-world investor stories, explicit do's and don'ts grounded in 2026 best practices including the integration of AI-driven tools like QuickBooks automated categorization and blockchain ledger apps for immutable records and knowledge points from industry surveys like those from the National Association of Realtors and American Institute of CPAs. Think of this as your detailed manual for creating an accounting system that's not just compliant but strategic, enabling data-driven decisions for scaling your portfolio. Whether tracking ROI on flips, managing cash reserves for multifamily maintenance, or preparing for 1031 exchanges. As always, this is educational. Engage a CPA or tax advisor for personalized setup, as state variations and federal updates like the new digital asset reporting rules can impact your approach. Let's break it down exhaustively, ensuring every element ties back to fortifying your real estate business. First, separating personal and business finances. This principle is the cornerstone of LLC protection and tax accuracy in real estate, where blending can invalidate your entity's status and expose personal assets to creditors or IRS penalties. Facts: under IRS guidelines in 2026, commingling violates the economic substance doctrine, potentially reclassifying business deductions as personal. While courts in cases like the 2024 Ninth Circuit ruling on a California rental LLC emphasize separate finances as key evidence of legitimate entity operation and failure led to $200,000 in personal liability. In REI, this separation allows clear tracking of property-specific cash flows, essential for qualifying for passive loss offsets and avoiding hobby loss challenges under Section 183. Pros: enhances liability shield, simplifies tax prep, and builds business credit via dedicated accounts. Cons: initial setup effort, potential for overlooked transfers leading to double taxation. Do's: 1. Open dedicated business bank or credit cards immediately post EIN. 2. Transfer property titles via quitclaim deeds and you file this with county recorder and this costs $20 to $100. Use software like Xero or Wave for segregated ledgers. Don'ts: 1. Pay personal expenses from business accounts and even reimbursements must be documented. 2. Use personal guarantees indiscriminately or delay separation. Step by step for 2026. 1. Audit current finances. 2. Establish business accounts. 3. Journal initial transfers as capital contributions. 4. Implement policies in operating agreement banning commingling. 5. Review quarterly with CPA. In real estate, this prevents cross-contamination, like a lawsuit on one rental affecting personal savings. Story: a solo investor. Jamal in Nevada mixed finances in 2025 for his first duplex, using personal cards for repairs, and an IRS audit reclassified $12,000 in deductions, imposing $3,000 penalties plus interest. Separating post-audit with dedicated accounts and QuickBooks integration not only resolved the issue but optimized his next flip's return on investment by 18% through precise expense tracking. Knowledge point. 1. 2026 AICPA surveys show 65% of real estate investment LLCs with separated finances report 20% lower audit rates. 2. Facts indicate blockchain apps like Ledger Live for crypto-linked investments add immutable proof against disputes. Next, chart of accounts for real estate, and this customized framework organizes your financial data into categories, enabling granular analysis crucial for REI metrics like cap rates and net operating income. Facts. Based on GAAP principles but simplified for small LLCs, a typical real estate investment chart includes asset accounts, liability, equity, income, and expenses. IRS Pub 946 on depreciation requires separate fixed asset subaccounts for MACRS calculations. In 2026, with digital tools like Bench.co automating categorization via AI, this setup facilitates compliance with new Form 1099 NEC thresholds. Pros: enables budgeting, supports lender reporting, and aids in tax planning. Cons: overcomplexity for beginners and software costs are usually $20 to $100 per month. Dos: tailor to your strategy and integrate with bank feeds for real-time updates. Also review with CPA annually. Don't use generic templates without customization, lump expenses, or neglect equity accounts. Story: partnership duo Sophia and Marcus in Illinois used a basic chart in 2025 but lumped expenses, leading to a $8,000 disallowed deduction in audit, but refining with property-specific subaccounts and Zero's AI categorization clarified NOI, securing a $300,000 line of credit for expansions. Knowledge. 1. 2026 trends include ESG expense tracking. 2. Facts show tailored charts improve forecasting accuracy by 40% per AICPA. Income versus capital contributions. This distinction affects taxation and equity in real estate LLCs, where misclassification can trigger phantom income or basis issues. Facts. 1. Income includes rents or flips. 2. Contributions or non-taxable increase basis per IRC 722 are owner infusions like cash or property. In 2026, with rising rates, the Fed funds 4 to 4.25%. Pros. 1. Proper contributions build basis for loss deductions. 2. Income categorization maximizes QBI, which is a 20% deduction under Section 199A. Cons. Valuation disputes in contributions. Dos. Document contributions with agreements. Use appraisals for property transfers. Don'ts. Treat loans as contributions. Expense tracking basics is essential for deductions. Facts. Categorize per IRS and use apps for receipts. Pros. Maximizes savings. Dos. Scan receipts daily. Don'ts. Guess estimates. Audit proof habits from day one and build routines to withstand IRS exams. Facts. Keep records 3 to 7 years. Pros. Reduces penalties. Dos. Digital backups. Don'ts. Destroy prematurely.